Hey, everybody. Welcome to week 148. It still blows my mind. I still chuckle 3 years into this. Oh, well, hey, and we've given Jack a hall pass. He gets 2 off in a row, evidently, because he's pretty special, but he will be back. So we decided, what we're going to do is we're going to go into common mistakes made by CPAs that are worth exposing. And we're not perfect at it either, but boy, do we see a lot of stuff that comes through. And so we're going to actually just talk about some of that because you should know about it. You should hold your CPA accountable, including us if we are your CPA. So it's a little bit of war stories, maybe not so much, but definitely common threads that we see. And yes, I am wearing the purple Charlotte FC new, and this is from the 704 shop. It's the most expensive t-shirt I've ever bought, but I liked it. And I like to support Charlotte FC. So 704 shop and yeah, so there are 7 crowns on the back. So love this city, love the people in it, most of them at least. And we love helping businesses in this city grow. So anybody jumping on here, you know the drill. Hit us with the Q&A if you do have questions. And I believe we have some new folks that are going to be jumping on here because I said, hey, you ought to be asking live questions because they weren't getting any answers out of their current CPA. And I said, well, no excuses. You can jump on with us. This is a group out of Washington, D.C. that I talked to earlier this week. So anyway, Adam, you may have some rants. Speaking of Washington, D.C., any crazy stuff coming out of Capitol Hill and having to do with taxes?
Beyond the usual crazy? No, again, I'm gonna sound like a broken record here for a little bit, but Gary, we got to get this crazy budget deficit spending under control. Okay, well, how do we do that? We're going to cut stuff. What stuff? Your stuff. Oh, wait a minute. Then I'm not going to vote for you. Oh, wait, I didn't mean it. I swear, I didn't mean it. Gary, we got to get this budget deficit under control. We're gonna go after people who ain't paying their taxes. Raise tab. Okay, cool. It sounds good. Well, who are we going to go after again? You, Gary. Oh, well, I'm not going to. Oh, no. So I just, I don't know. I mean, it's fun. It is. I know, Gary. We've had our friendly discourse, in the past between you and me. But what it really made me kind of reflect on is that, we actually had a really good bipartisan proposal to fix this mess that did involve pain. It was called the Simpson-Bowles proposal, which was universally rejected by all elected sides.
Except for Bowles and Simpson.
except for Bowles and Simpson and the unelected bipartisan commission that was tasked with creating it. So you know what the plan is? There's actually a really good plan. I think they came up with it in, I think, 2010.
Yeah.
And it just, it just didn't go anywhere. So it's like, it's like, I don't think Obama said 2 words about it, and at the same time, it's not like the Republicans picked it up and, said, Mitch McConnell said, oh my God, greatest plan ever invented. Let's get all over this thing. Why was it? Because it involved some cuts and involved some tax rate increases, which is just like the facts of what's going to have us not be in this mess. So anyway, that's rant number 1. Rant number 2 is, I guess, I don't know if it's a rant or not, but it's, every time I brought up future tax rate increases with people, I don't know how many people are listening. So I just wanted to lay out kind of the facts on the table of what actually will happen. In 2026, most of our clients will see about a 10% tax rate increase if Congress does nothing. And the reason for that is that the Tax Cuts and Jobs Act expires in 2025, which is what we're, some of the boo-boos that we're going to talk about are boo-boos related to the Tax Cuts and Jobs Act. It expires in 2025. So in 2026, guess what? Congress does nothing, just literally nothing. Doesn't have to do anything, just has to do nothing. Then everybody gets a 10% tax rate increase. And I've gotten into arguments. It's funny because like I've gotten into arguments with people about, well, I mean, they're, surely they'll do something. It's like, no, I actually don't think so. Because in order for something to happen, it would mean that Republicans would have to control the House, the Senate, and the White House in 2025, which is when they'd have to pass this, or sometime in 2026. So that's the first thing that would have to happen. The second thing that would have to happen is they'd actually have to agree. Which, I feel like the Will Rogers quote, that he used to apply to the Democratic Party. I belong to no organized party. I'm a Democrat. I kind of applies to Republicans now too. So they'd actually have to agree to actually take some action instead of no action. So what do we have to look to? We have to look to worst case, probably 10% just expires. Maybe case is the Senate proposal that passed the Senate, but then went nowhere in the House, was that was going to be about a 5% rate increase. So I just, I think people just need to, kind of plan accordingly. It's like when you're doing tax planning, deferring taxes into a future year is a great strategy. Like, why wouldn't you do that? Except for when I'm deferring into a higher tax rate, which means, again, real easy example, let's say that I defer $100,000 in income, today, Gary, that is 30 grand in tax today. That will cost when I defer it into a 10% tax rate environment, 40 grand. 30 goes to 40. So I need to make sure that 100 grand is earning a lot more than the difference. So if I said, okay, Gary, I'm happy to do this, what are you gonna do with the 100 grand? You're like, Adam, I can make that 100 grand 400 grand. You should do that all day long. If the answer is, Adam, I don't know, I'm not gonna do anything with it, the answer is, well, why would you cost yourself 10 grand just to stick it? Yeah, you're really sticking to the man. But you're the man, you stuck to yourself. So sorry, Gary, rant complete.
Well, so that actually brings up one that we ought to talk about: Roth IRA conversions, when to do it, how that works, limitations, etc., because that is something that we see often that's not necessarily brought up by other CPAs. But a few of the things that we have seen that we've talked about, QBI and wages, and Adam can decipher what that is. Cash versus accrual accounting. Those are, there's some nuances in there, and there's some limitations when you can no longer do cash accounting. Cost segregation studies, if you own commercial real estate, R&D tax credits, transaction structures. Also, in the bookkeeping side of things, a lot of times, like, here's a universal truth. Everybody thinks that I shouldn't say everybody. Most people think that their books are clean. Most of the time, a whopping large percentage of the time, they're not. And it creates issues. So, kind of dealer's choice on that one, Adam. Let's go down wherever you want to go first.
Yeah. So, I mean, I kind of like the way that you had the order is usually the way that we find the findings. So, the probably the biggest issue that we see, and this is like, I'll give you the absolute worst case scenario and then get into the more common typical scenario that we see. So what ends up happening is, Gary, you're a new business owner and you're like, man, I was working for Bank of America, what kind of, I need to start a company. I'm going to go into consulting, start doing my own gig. It's going to be great. I'm really excited about it, but I've never owned a company before. What do I do? I don't know what to do. Right. So you come to your accountant, you're like, well, what? And you go to your lawyer and like, well, what should I be? And, one of the questions you're going to ask is, well, Gary, you going to have any partners or not? Gary's like, hell no. No partners for me. Like, okay, that's fine. The advice that we're going to give you then is, then, gobbledygook, 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 gobbledygook. You ought to be an LLC taxes and S corporation or just an S corporation, but probably an LLC taxes and S corporation. And you're like, blank stare, sounds good. Whatever you say, that's fine. And then, the person in my chair says, and the way it works is you got to take a wage, got to have a paycheck, got to have a distribution, then you can also take distributions. You're like, gobbledygook, 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 gobbledygook. Okay, how do I start with that? Well, you sign up with a payroll company and you just pay yourself maybe 50 grand a year to start off with. So Gary does that, and that's based on, well, I think I'm probably going to bottom line make about 100 grand, 50. So I'm going to take your advice and say, I'll take 50 grand in wages and 50 grand in distributions. How do I pay myself? Well, you go 50 grand in payroll and then just write yourself a check for the other 50 grand throughout the course of the year. Like, all right, that's fine. So, love Gary, but Gary isn't as wildly successful as he thought that he would be.
That would be a true statement.
And therefore, at the end of the year, Gary's got a $50,000 W-2 that shows income. He was not able to make any of those S distributions to himself because he was a colossal failure. Sorry, Gary, love you. And the business shows a $50,000 loss. So because Gary paid himself 50 grand. So had Gary not paid himself anything, the business would have been breaking even. But since Gary paid himself 50 grand, Gary lost 50 grand. And you can say, like, on the one hand, what's the big deal? Blah, blah, blah. Is that big of a deal? Because I'm going to have the loss, that comes from the business. It's going to be applied against, my wages. I'll get my tax money. Well, except for your Social Security taxes, Gary, you ain't getting that back. So that decision just cost you. Get your calculator ready, Gary.
3%?
No. 15%, because even though you're thinking payroll, like from the employee's perspective, remember you're now the employer and the employee. So what's 50 grand times 15%?
$7,500.
Cost you $7,500, Gary, for doing that you can't get back. That's the worst case, and unfortunately, we actually see that case a few times. The more common scenario, though, is that Gary comes see me, set up, blah, 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 well, what do you think you're going to make? Well, I'm actually going to be pretty successful. I think I'm going to make, $250,000, next year, bottom line. And, then eventually, hire some people and really build these things up. And, I still hear the thought of the 50-50 split, that's what I'm hearing, and Gary, so Gary just keeps that intact. So he starts at, 50 grand becomes 100 grand, 100 grand becomes 200 grand, 200 grand becomes 400 grand. So now we're sitting in year, 4, and Gary has a $400,000 W-2, and he's got $400,000 in distributions. So the company made 800 grand. Gary took 400 in a paycheck and 400 in S distributions. So a lot, you're like, oh, it's still 50-50. Isn't that what the IRS says? No, all the IRS says is that Gary has to take a reasonable wage. Gary, you're freaking amazing. But how many consultants typically, if you hired them, you would pay them 400 grand?
Not many.
Right. So there's your reasonable wage. So the IRS would say pretty much anything up to Social Security limits going to qualify for us for reasonable wage. You know, if you look at compensation surveys, even if you're the CEO, it's like not many CEOs of middle market companies make more than 250, you know, so it's like you got all these data points that are not 400 grand. So what did you leave on the table in that scenario? Well, that's a doozy, because you took 400 grand. We're going to keep the math simple, and assume that you should have taken just 100 grand, just to keep it real simple. Got your calculator handy, Gary?
I got it ready.
In that scenario, you had $300,000 of excess payroll taxes. That is your 3% number. So that's 9 grand, right?
Yep.
And then because you took the money out as in a wage, that's 37% money, versus had you done it via distributions, you get the benefit of the qualified business income deduction, which is basically only pay, 80 cents on the dollar on your bottom line taxable income that you take as S distributions. That cost you 9%. So what's 9% of $300,000? $27,000, right?
Yep.
Yep. So that decision cost you $27,000 plus $9,000, which would be $36,000 permanently in tax savings that you left on the table. And we typically find that, I would say, I mean, you do a lot more of these proposals than I do, but I think probably that is found 75% of the time.
I was going to say 80. And so, yeah, you're right.
So long story short, make sure that you are thoroughly analyzing, what am I paying myself? And is that fully optimized from a tax perspective? So that is item number 1, most common finding that we see.
Before you move on to number 2, I'll give an example. We had somebody that's been with their CPA firm for like 20 some years, a couple companies that they've had. But with this particular company, they've had, a good bit of time. It's multi-generation. And this was the one thing. And it was a big firm out of state that was handling them. They had operations out of state and they've moved to North Carolina. Smart move. And we found them gobs of money. I mean, it was like 6 figures. And the CEO, the founder, the patriarch, was mad. He was like livid. He was just like spitting nails. But this was one of those areas. And he, before, when we were talking to him, he's like, I'm dealing with the, major partners there. I've been, we're good buddies, blah, 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 blah. And now all of a sudden he feels betrayed. But the problem was, and I said, listen, man, the guy they weren't trying to be jerks. They just went really conservative, and they were doing the 50-50 split on their wages for him and 2 other family members that were key in the business. But that was the issue. They just went super conservative when the tax code allows far more flexibility. And it's not like you're going to go to jail or you're going to get fined for that. It's defensible. We haven't lost on that one. So
no,
we haven't lost on any of them, quite frankly.
Yeah, that's exactly right. So then second most common one that we find is the difference between being excuse me.
Bless you. Bless you.
I gotta tell you, Gary, loving the warm weather. Adam's nose is not loving the warm weather.
Oh man. Yeah, the Piedmont's tough.
Or I got the Rona and nobody told me. It's like I refuse to get tested now. Like I'm just not testing myself.
you would know. You would believe me. You would know.
Yeah.
If you had what I had, you'd know.
Anywho, so in the cash accrual, basically you have 2 methods of being a taxpayer. One way is called a cash basis, which just like it sounds. If I collect money from a customer, it's taxable income. If I pay money out to a supplier for an expense, it is a deduction. That basically follow your tax based on how cash flows. The other method is that you can be an accrual basis taxpayer, which is more of like what you learn in school, which is you're taxed how the money earned. So so Gary's my customer, I send him an invoice for $100,000, even though Gary hasn't paid me. That's a taxable sale. If I say, Gary, you're my employee, you're doing amazing. You've earned a bonus this year. I'm going to pay you in January. That's still a deduction for December, because I've accrued it. So I'm following kind of economic interest. So the common things that we find here, are exactly like I said, you already have the correct base of accounting, but you aren't taking full advantage of it. So for example, if you are in the business of paying bonuses to your folks and you typically calculate that in December, but you pay it out in January, you get it. You can take a deduction for that in the preceding tax year. So it's just little stuff like that, that if you add those up over time, can end up being some pretty big accrual swings that exist. But in terms of the cash basis side of the equation versus accrual side of the equation, one of the benefits of the Tax Cuts and Jobs Act that just, it existed, I don't know why people didn't catch it, is that it used to be that in certain circumstances, you could be a cash basis taxpayer, which is always advantageous if you're growing, because, if I'm growing like crazy, it just really sucks to pay taxes on money that I don't have in my bank account yet, period. So you want to use it as a tool. Well, it used to be that, $10 million in sales was kind of the number that you had to look at to determine whether or not it should be cash versus accrual. And they raised that up to $25 million. So first thing is people just missed it. It's like, so they were accrual at 13 million and didn't realize that they could convert over because they're not at 25 million. That's number one. Number two is that even within that, where by law, I've got to have some accrual basis accounting, meaning like I manufacture stuff, so I'm supposed to be an accrual basis taxpayer. There are still nuances that existed within that where I could be cash-like, meaning like I could expense the labor component that goes into my inventory, even if I don't do that for book purposes. So there are all sorts of little things that existed like that can end up having massive swings. I mean, if you make somebody be a cash basis taxpayer after they've been accrual, it's like guess what? No taxes for you for a year, because you've already recognized the receivables that are sitting on your balance sheet, and you're not having to recognize the ones that are sitting on them now. And that's a big change, for a lot of people. So, going back to this one, it's like missing the conversion opportunity when you had the opportunity for the conversion opportunity to exist. That's number one. And then two is not taking complete advantage of the opportunities that are there for you.
Cool. That's helpful. And we do see that pretty frequently, not 75 or 80% of the time, but I'll bet you 30 to 40% of the time we do.
Yeah, it's crazy.
So if you have a commercial building, cost segregation is another one of those that I'll bet you it's kind of 50-50 where they don't know. And this example that I gave you earlier today, where we found QBI, we're like, hey, you guys have a commercial building that you own, right? Yep. Well, have you guys done a cost segregation study? And they're like, we don't know what that is. Yeah. Oh man. I mean, like, you are just bragging about you had your, one of the partners that's one of your good buddies and blah, blah, blah. Well, I'm not sure they're such a good buddy or they're asleep at the wheel. So talk about a cost segregation study, Adam.
Sure. Yeah. So on that one, so the what had happened was, so it used to be that with real estate, one is you can never depreciate land, like the raw land, and you still can't depreciate raw land. But when it comes to the building itself, like I build a building, it used to be, hey, I'm building this building, and it's got a long life because it's a building. Like, you still see buildings in, New York or Washington DC or whatever that are old. They're really old. So what's a good time span for a commercial building or a residential building? I don't know. Could it be 27 and a half years? Could it be 39 years? But whatever they came up with of back in the old days for, like, hey, that's the time frame that you got as an appreciable life. And that was the case for a long time. Well, God bless him, a hospital that kind of got for profit, got kind of pissed off at that, said, have you ever been in a hospital, like seen how often we have to refurbish this crap, that exists within it? It's like, it's ridiculous that it's 39-year property when we have to replace stuff. Like, we have to repave the asphalt every couple of years. We got to remodel the rooms. We got to do blah, 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 blah. It's like, that's crap. So they actually, believe, went to court and argued that their building should be allowed to be broken up into separate components into more accurate depreciable lives, such that that big multi-million-dollar building went from 39-year property to some 39-year property, some 15-year property, some 7-year property, some 5-year property, based on the underlying lives of the subcomponents, if you're to look at them in isolation, like carpet, asphalt, stuff like that. So what a cost segregation study does is it's exactly that. It basically takes your multi-million-dollar building and looks at the different construction packages and values, like carpet, frame, shell and core, driveway, HVAC system, all that kind of stuff, and says, okay, what is 39-year property versus what's not 39-year property? And, if you do this correctly, you usually, depending on the nature of the building, you can get, 25, 30% of it is typically going to qualify for much faster depreciation that is more, even if you don't replace it in that time frame, you still ought to take advantage of it. So it qualifies as more, faster depreciation. It's like, it's shocking how many people don't do this.
Yeah, we did it on a commercial property that our private equity firm owned up in Cleveland, Chagrin Falls, Ohio, to be exact. And that was in 2005. So that was really early. There weren't a lot of people doing it. And it was so early that the IRS said, hey, what is that? And we won. It was a pain in the butt, but it was because it was so early. Well, that was, 18 years ago?
Yeah.
Something like that. So anyway, so cost segregation studies, if you own a commercial building, you ought to do it. Doesn't apply to residential, but it does apply to commercial.
I mean, it does apply to residential in the sense that if I bought something, like, I can still carve out, some stuff, like if I bought, my beach house, it's like,
well, there you go.
You can carve out, HVAC contents, all that kind of stuff, that people overlook it even on residential.
Even if let's say, just for clarification, for my own understanding, if it's a rental, that makes sense. But if it's just your primary residence, same thing or not?
If your primary residence, no, it's only
Okay.
if it's a residential rental.
All right, there you go.
Yeah.
Thank you for clarifying.
Yep.
Next question, R&D tax credits, because there's been some changes in that. And a lot of times, again, people think, well, I'm not a tech company. I don't qualify, but that's not necessarily the case.
Yeah. So on this one, even the IRS would say this is one of the most commonly overlooked tax credits that's available. So with the research and development credit, there's a multi-factor test. It basically says, hey man, if you're in the business of, developing new processes or new things, you get a credit for the labor dollars that you spend on developing those things. So what the IRS has effectively done with this is interestingly, instead of saying what qualifies other than what I just said, because there's not a whole lot of details around what qualifies other than what I just said, what they've done instead is say what doesn't qualify. So unfortunately, Gary, as much as I believe tax planning ideas are amazing, the process that we go through to come up with new tax planning ideas does not qualify for the research and development tax credit. But, generally speaking, if I'm in the business of, again, it's software, it's easy. If I'm developing a piece of software, I go through a systems development life cycle. The outcome of, hey, is this thing going to work or not? Is it really known? I've got a pretty good idea. Iterative processors, testing, that's obviously going to count. Manufacture a product, I can, hey, I've got R&D in that thing, that clearly counts. Where people start to kind of miss out would be like, take the manufacturer, for example. Back at Arizona State, when I started off as an engineering major and quickly got weeded out, there were two kinds of engineering. You had mechanical engineering, which were the real engineers, and then you had the process engineers, which were the imaginary engineers. Sorry if I offended anybody on the call, but that process, like, hey, how do I do the line, to make this happen? And reconfigure stuff, invest in like tooling and all that kind of stuff, that qualifies as well, because you don't know if that's going to work, to drive an efficiency. So even though you're the internal beneficiary of the research, that can qualify. I've got to make some heavy modifications where I create my own software that's only for me. I don't sell it, but I use it in my process. That can all qualify. So, I think the only time that I've seen that been like, that's BS, that's not going to qualify. It's like, we did have, a dental practice that got called on by a guy, dentists qualify for the R&D credit. It's like, well, yeah, like if you're inventing new stuff, in the world of dentistry, but someone was trying to make the claim that no. If you go to continuing ed and you learn a new procedure, it's new to you. That every time you do that procedure, that qualifies. It's like, that's actually not true. You will not win that argument because the outcome of the procedure working or not is known. Someone else invented it. The guy that invented the procedure, he qualified, but you just taking what he had does not qualify because you made no modifications to it. Like you did nothing to further the research, within it. So anywho, there are some people that try to go a little bit on the too aggressive side of the house. Another one where it's like, same type of companies calling architects. It's like, yeah, all architects qualify because you don't know if that building's going to stand or not. It's like, isn't that why you were hired? However, inventing something new within that, that's never been done before, like the first guy that did, a concrete form or that's brand new or, tried a new type of steel, that guy could qualify. But the guy that did it, the 5,000 time that it was done, but it's the first time he did it, he did not qualify.
Yeah, that's good. Before we move to another one, there are a couple programs that came up during the COVID lockdowns and all that kind of stuff. ERC the employee retention tax credit, as well as the Restaurant Revitalization Act. I think that's what it was, right? Something like that. Both of those are kind of coming to their natural ends. Anything that you would mention just as a reminder to anybody?
No, yeah. Anything that you think that I should add?
No, you know, I'm thinking of one of our mutual clients with Jack Santinello, and they hadn't done anything on ERTC.
Mhm.
They had been getting the same kind of spam from everybody else saying, oh yeah, you qualify. They didn't think that they did. And so we're taking them through that. How much longer do they have before that, you know, they can't submit anymore? Do you remember, Adam?
Yeah, it's a good question. That's 7 years, I believe, is the stat. No, sorry, 3 years from, I think, January of, the first quarter payroll period, which would have been like April reporting date in 2020. So it's 3 years from then is going to be your time frame, I believe, for the statute of limitations. So you still got a little bit of time for that first quarter before it falls off.
Okay. So when we're talking about transaction structures, whether it be to an outside PE or a strategic buyer or something like that, or an internal thing, there are some tax advantaged ways that you want to kind of get ahead of the game before, hey, I've got an LOI, here we go, right? So there are some things that can be done depending on what kind of company you have. If you are an LLC taxed as an S Corp versus a C Corp, there are some advantages if you're an S Corp, and I'm thinking Popeye plan here, Adam. Yeah. And one of these, if you would just go kind of generally, and then maybe if you want to go into kind of the high level on what we have done for some clients with the Popeye plan. And I'll never forget, one of the guys that is a friend running a company was mad at their current CPA. He stayed with that CPA after we gave him kind of the roadmap, which was kind of a lesson learned for us. But he was like, why didn't my CPA tell me? And it's a big firm. We're like, I don't know. So, but we would have saved him a lot of money, because it was like double taxation of what the road that he went versus the way they were going with us. So it was a lot of money.
Yeah. Yep. So basically in terms of transaction structure, I think the two biggest gotchas that we see there, number one is, let's go the strategic buyer route for a minute. So basically, if that's your route, like third or private equity, it's like third party sale, not internal sale. The problem we see there most often is that, Gary, you're amazing. We love your company. We totally want to buy it. And then I shoot over this LOI that says we're going to acquire the stock of MacGyver Corp. It's going to be great. Gary's like, sweet, capital gains.
Right. And
you've done your little math, if you're kind of sophisticated, saying, oh, well, multiply that times 20%. That's what's going to be my taxes. And then here's going to be my net proceeds. And, da, 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 da. It's like, it's all going to be great. All going to be great. And then 5 days before the transaction's set to close, I say, I need your consent to do a 338H10 election. Like, huh? Yeah, no, I'm still buying your stock, but I want to treat it as an asset sale. Oh, wait a minute. Next thing you know, Gary's capital gain treatment is 0.8A. because he's going to have some ordinary income items like depreciation recapture. And he's going to have, if he was a cash-based taxpayer, it's as if his receivables were deemed paid. So he's going to have, ordinary income and all that stuff. So it's one of those things where, we've seen this be big enough. And if it's a C corporation, it's even worse. But we've seen this be big enough that, it can cause Gary to think he's putting 100 grand in his pocket and he's really only going to put, 55 or 60 in his pocket if something doesn't change, which would completely change your calculus on whether or not you would have taken the deal in the first place. So our advice is always to say, you got to get the tax treatment negotiated up front. And when it says stock sale, that does not mean, like, I've never have I, and Jack and I've covered this before, we can't think of a single instance where an S corporation stock sale or a C corporation stock sale stayed as an S corporation stock sale or a C corporation stock sale. They always end up converting into asset-based sales because it's advantageous for the buyer. And you just want to make sure you get made whole on the seller end and kind of know that up front versus getting worn down and having it thrown on you at the last minute. So that's number one. The second, though, is when you look at internal party sales. So, Gary, you're amazing and, you've been really loyal. I really want you to buy me out and take this thing over, and Gary's like, sweet, I'd be happy to. I don't have no money. So how are we going to finance this? Oh, no, Gary, I'm going to make it super easy for you. I'm going to finance it. So, I'm just going to, fade off in the sunset. You can take what I've been paying myself and my salary and, my distributions, and you just turn around and, pay that to me. We're all good. You take over the company. So the default answer would be to say, let's treat that as a stock-based trend. Gary's buying the stock from Adam, but this doesn't matter if it's Popeye plan or structured a different way. That just gets down to timing and the nature of the company because it has the same effect. Well, if Gary buys my stock, let's say again, same $100,000. Well, I'm going to put 80 grand in my pocket. I'm happy, paying my taxes, 20 grand on the transaction. Gary, on the other hand, to pay me $100,000 had to earn the 100 grand and pay taxes on it. So it really cost Gary about $135,000 of generated cash to be able to put 80 in my pocket. Wouldn't it be so much better if I could restructure that transaction whereby I still get my same 80 grand, but Gary actually only has to pay 100? Of course it would. And the way that you do that is you just agree to, changing the nature to go from, stock-based sale to some form of ordinary compensation or redemption over time, that whereby Gary really gets to pay only the 100 grand, or I get allocated income, and then get a redemption for my stock over time. But either way, Gary's not having to earn 135 grand to pay me my 100. So if I'm willing to finance the transaction, which most internal buyouts are going to be seller financed, it's way better if you get ahead of those and structure those as, hey, Adam, I'm just going to pay you to help coach me, mentor me, keep the customers intact, consult from time to time, help me out with sales, and I'll give you $1 for your stock, or alternatively, okay, Gary, you're coming on board. I'm going to give you 100 shares. And then over time, you're going to retire my 1,000. The company's going to retire my 1,000 shares to where there's only 100 shares left, which is what the Popeye plan is. Either way, it gets the same answer. I get to put my 80 grand in my pocket, and Gary only has to pay the 100 grand that he thought that he was signing up for instead of the 100 grand plus the taxes on the 100 grand that he had to earn.
Yeah, I think the bottom line is, and you said it earlier, if you are considering selling in the next couple years, make sure, or even, you got something that's a little bit closer in, make sure that you bring in your CPA firm, that they know what they're doing, and your attorney, but to have that tax implication conversation up front, because once you're in a deal, you do get worn out. I mean, it's exhausting. You're running your company and you're having to find this, find that. I mean, it's exhausting. So that's why they usually do that at the end. Oh, and by the way, because you're already beat up and you're brain dead anyway. So that's important. And just knowing that, hey, there are options for reducing your taxes if you structure things right on an internal sale, because the default that most CPAs that we've seen when we've brought this thing up with somebody that's kicking the tires with us, and they bring this particular thing up, their CPAs went with the most conservative option, which is what Adam talked about, where you net 80, but the person that's buying you out has to earn 120 or 135 versus 100. So I think that's quite helpful. The last thing, this has to do with taxes but it's not directly taxes. So let's talk about things that we see where things are screwed up in charts of accounts, where they're allocating certain things into certain places that becomes kind of a mess. And we really see this, especially in construction construction contractors, like general contractors, where they're managing multiple subs and all kinds of stuff going in and going out. And they usually start with somebody that's cheap or free, and then they graduate, and then it's the hairball has gotten into a big, snowball that's careening down the mountain. Anything that you want to talk on that, Adam?
Yeah, so it's funny because you kind of said it exactly right. How it happens. It's like, who's your bookkeeper? My wife, sister, cousin, brother, whatever, that, they're trying to do the best job they can, but eventually they get out of sorts, and you got an owner that like doesn't really use the financial statements for anything other than to supply them to a bonding company, bank, or whatever. And this doesn't have to just be a construction company, it could be anybody, but it's funny. It's like, you would be shocked at how many people say, hey, everything's working right, we know exactly what we're doing, and the first thing we check for is, when's the last time you reconciled your bank account? Like literally 15-20% of cases that we bring on board haven't even done that. And it's like, geez, if we don't even know how much if we're not even getting the basics right, it's like, how can you rely on anything else? So what we end up doing, and that kind of, the same thing applies to the rest of the balance sheet accounts that exist, other stupid ones, recording, deposits or owner contributions as income, like just some basic stuff that we see that, you feel that it's accurate, cash is right, but you just didn't, you just missed the mark a little bit. So it, we do strongly encourage people to, have a set of written, and we always help with this, but have a written set of, do this daily, do this weekly, do this monthly, do this quarterly, do this annually. If you do that, you're going to be fine. If you don't, that's when it starts to get out of control. And, a lot of people are like, well, so what? Well, the so what behind it is that, first off, we want to make sure that we're not missing anything. And if we're having to do a bunch of cleanup work, then it means that we're not spending time focusing on what were the planning opportunities, that existed here. That's so what number one. So what number two is, there's lots of I think, last week we did a presentation on, the banking community. I didn't put up another thing that'll make a banker frowny face, not being able to rely on their financial statements. because they're garbage. That will make a banker, meaning there's very massive differences between what you're providing and then what your tax return ends up showing, with no clear answer on what the hell happened. That's another way to piss off your banker. That's why it's important, is access to capital. That's even independent of using them as a tool to help you make more money. So as I said, it's pretty common. If you go into construction, what's really common, I've got a work in process schedule or job cost schedule, and it doesn't tie back to my balance sheet. It's like, that's kind of a basic one. Or I made modifications to my financials after my tax return was complete. So all of a sudden my prior period balances don't all match up. So just silly stuff like that, Gary.
Yeah, that's good. One other thing that I think is really important is, it was underscored by a conversation I had with a prospect this week, and they're really good in what they do. As in, if anybody has made it past the first year in business, congratulations, you're doing something right. It's a hard lift to get the inertia and get a business moving. But most business owners, and I'm thinking about even our largest client, they are really good at what they do, but they did not understand their financial statements. That's not what they went to school for. That's not their bread and butter, but they knew enough to kind of get by. But one of the worst things that you can do is just suffer in silence and pretend like and make sure that you're getting honest answers from somebody. And if they're making you feel bad, or they're browbeating you and making you feel stupid, you're probably with the wrong firm.
Right.
There's arrogance there. You need to be with somebody that understands the fact, hey, you're a successful business owner. This area of the lane really well. Let us help you with this lane, because once you understand your financials really well, and we've got people that are on this call pretty regularly, that Adam has done that in a massive way. They had the humility, and they were running really good businesses, but not nearly as profitably as they needed to be. And so I would just say that's another mistake.
Right.
And it's usually on the side of the client, not, just not pushing their CPA to say, hey, help me understand this. And again, if they're browbeating you and making you feel stupid, you're probably with the wrong firm. And then the one final thing that I'm going to throw into this thing before we shut it down, any questions? I mean, it's been pretty silent back there. Hopefully this has been valuable to you guys, but I had a coaching client that was doing about $30 million a year. And it was taking them 3+ months to close their monthly books. And it was out of freaking control. And now they're doing about 90 million. That was 4 years ago when they were doing about 30. And when the CEO and the founder, his young guy, started it when he was really young, said, do you coach, my VP of finance? And I go, do you do leadership development? I said, why? And he told me it's taken him 3+ months to close the monthly books. I go, coaching and leadership development is not going to solve that. You got somebody that's in over their head. And what they really needed was a fractional CFO or a full-time CFO. They had a fractional CFO, but it still was too much. They really needed a full-time CFO at that point. But if basically you're careening down the road at 90 miles an hour and the windshield is painted black, you can't see through it. That's what it's like running, with 3 months, not knowing what's happening with your financials. And especially in this guy's business, because he had perishable commodities that were part of their inventory. I mean, and the margins on some of that stuff were pretty thin. So anyway, I would just say, look at that. If ideally less than 15 days, if you can get into the 5 days, that's nirvana. But, typically 15 days after the monthly close is good. Anything you'd add to that one, Adam?
No, I think you pretty well got it. I mean, if you can't get them closed up fast, you just got to be asking yourself why.
Yeah. And again, usually it's because, oh, well, it's my daughter, it's my nephew, or, my wife's cousin. and I don't want to rock the boat. We get it, but it is like, I mean, it's dangerous. It is like careening down the 77 doing 80 miles an hour right before you hit Charlotte, and the windshield is black. You can't see through it. So it's a very dangerous thing. It can be. So any questions from the gallery before we shut it down? Lord willing, we'll have Jack with us next week. Go ahead.
Sorry, I'm just coughing and about ready to sneeze again. Sorry.
I thought I heard Chewy in there early on in the.
You might have, but she's all good now.
We'll have to have a Chewy cameo. Anybody that came on here late, most of you guys were on here pretty early on, but if you missed some of the front end, we will put this up on the BGW CPA YouTube channel later on this afternoon. Thank you guys for being with us next week, 149. Thank you, Adam.
All right. Awesome. Thank you guys.
See y'all. Bye-bye.
All right. See you. Bye.